Hey everyone, thanks for tuning in to our September 2025 Investment Committee Update. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Markets globally, including stocks, bonds, real estate, and commodities, all continue to trend higher during September. Signs of market rotation also continued to appear throughout the month, as leadership within the equity markets has been broadening out. The U.S. federal government entered a partial shutdown to begin October after Congress failed to pass a funding bill before the start of the new fiscal year. As a result, up to 1 million non-essential workers will be furloughed without pay, hopefully likely to receive back pay post-resolution. This could dent GDP by between 0.1% to 0.5% per week. The U.S. labor market continues to weaken. Private payrolls data from ADP shows that net job losses have continued over the prior 2 months. The official jobs data may be delayed due to the government shutdown. Despite these economic data points, ongoing uptrends across most areas of the equity market is a healthy sign of the strength of the current bull market. However, many measures of valuation and investor sentiment, especially within the large cap U.S. growth segment and recently within the more speculative lower quality sectors of the stock market, are raising cautionary flags that must be monitored. One in particular, the Buffett Indicator, reflects the total valuation of the U.S. stock market relative to the total output of the U.S. economy. As Stephen will review, this indicator is at unprecedented levels, reflecting extremes in the price that investors are willing to pay to own the U.S. stock market. Needless to say, indicators like these compel us to take a prudent view of risk management at this stage in the market cycle. At this juncture, economic and stock market momentum are highly dependent on the AI boom, which may in fact represent the fourth industrial revolution. However, the level of investor euphoria over AI and the degree to which the stock market's strength is tied to it raises concerns and must be logically evaluated. With that, I'm now going to turn it over to Stephen to walk us through this month's review.
All right, thanks, Chad. So as always, let's jump in and let's start with a big picture view of what's happening here in the market and in the economy. So we're going to begin by examining this Buffett Indicator. Chad and I actually did a short video on this towards the end of September. But this is a simple tool that Warren Buffett has used over the course of his investing career as a barometer of whether a stock market is cheap, fairly valued, or maybe expensive. And the formula is pretty straightforward. You take the total value of the stock market, which is referred to as the stock market capitalization, and you divide it by the size of the economy, or the GDP. So theoretically, this ratio would be around 1 or 100% in a fair value situation, but that discretion still remains in the eye of the beholder. So where do we stand today with this Buffett Indicator, and does it really still even apply? Well, we ended the month of September with this ratio around 220%, highest ever. So according to the Buffett Indicator, the U.S. stock market has never been as expensive as it is today, ever. Now, towards the end of the dot-com bubble, Buffett famously was sitting out of that strong stock market rally. And he cited, among other things, that this ratio, it was well north of 100%, right? In fact, it got to as high as the upper 140s, almost 150 before it peaked. So in that environment, he just elected to abstain, sit out. Well, we all know how that story ended. The S&P 500 fell nearly 50%. The NASDAQ fell nearly 80%. Well, fast forward to 2008, in the midst of the financial crisis, this ratio, it was plumbing 50%. The Buffett Indicator was suggesting that U.S. stocks, they were as cheap at that point in time as they've been since the Gulf War in the early 1990s. And so at that time, Uncle Warren famously penned a Wall Street Journal op-ed as the markets were collapsing in the fall of 2008, titled "Buy American, I Am." And so he was once again going against the crowd, whom at that point in time they were selling. Markets would bottom about 5 to 6 months later in early 2009. And since then, the U.S. stock market has been on a historic run. But in the last 4 to 5 years, Uncle Warren, he has been building a very large cash pile. He hasn't bought much of anything, U.S. stock-wise, since he really took some positions in the U.S. energy patch back during the COVID doldrums. And he's been pretty open as to why that is. He doesn't really see any compelling values here in the U.S. stock market. And at these valuations, certainly not hard to see why he would think that. Now, let's move on here. So September saw some very interesting news in the technology space, where several companies they're fashioning deals together with each other. So started with NVIDIA, a leading semiconductor chip maker. They inked a deal with OpenAI, which is an artificial intelligence company, a newer company. NVIDIA is going to invest up to $100 billion into OpenAI starting in the middle of 2026. Now, following that news of that pending capital infusion, OpenAI signed a deal with Oracle for cloud computing services worth $60 billion a year for 5 years. And in order to meet the technology demands of the OpenAI deal, Oracle is going to need to purchase $100 billion or so in semiconductors from NVIDIA. Interesting, right? Now, so on the news of that OpenAI deal, Oracle's stock, it leaped higher. Had the best day that it had had since the early 1990s and was for a very brief moment a $1 trillion company. But some skepticism set in later in the month. The stock fell about 20% from the highs that it had achieved post the announcement of that deal with OpenAI. Now, why the skepticism? Well, here's a quick excerpt from the JP Morgan analyst Michael Simblist, who covers the space, and I like his take on it here. So he said, on the news of this OpenAI deal with Oracle, Oracle's stock jumped by over 25% after being promised the $60 billion a year for 5 years from OpenAI. That's an amount of money that OpenAI doesn't earn yet. And they are contracting with Oracle to provide these cloud computing facilities that Oracle hasn't even broken ground on. They haven't even built it yet. It's supposed to be delivered in 2027. That's less than 2 years from now. And oh, by the way, the power required to be able to have those cloud computing facilities operational, those data centers, to have it operational, it's going to require 4.5 gigawatts of power. That's the equivalent of more than 2 Hoover dams or 4 nuclear power plants. That is a tremendous need for electricity, for energy, to be able to bring this deal to bear. And this is supposed to happen in 2 years? The last nuclear power plant that we built in this country took over 20 years to construct. And they think that we're going to have 4 of them done in the next 2 years? Madness. Madness. Maybe some prudent skepticism is what we need here analyzing where we stand in this part of the cycle with these technology companies seemingly to just refresh their money within each other, but nobody ultimately goes anywhere. So, all right, let's move on. And we're going to go through some charts of the key asset classes, starting with the large cap U.S. equities. So we're looking here at the S&P 500 index as a proxy of that category. And we see that it remains in an uptrend that started back here in May after that Liberation Day sell-off. And we've got the S&P 500 closing the month of September at new all-time highs. Mid-caps also in an uptrend, although we can see that they are still underwater slightly from their former highs late last year. And if you went security by security, even in the large cap stock universe, this is much more likely the pattern that you would see where we're still below those former highs. That's more likely the pattern that you would see if you went security by security, even within the S&P 500. But we've talked a lot about how those largest companies, those tech names, have really pulled the index higher when that isn't necessarily the case for the majority of the stocks in the index. Anyhow, mid-caps finished the month of September up around 0.4%, so still a positive month, but still some ways to go before we're pushing on new highs here. Small cap stocks, they too remain in an uptrend following a meaningful tariff-related sell-off here early this year. They are still just below their former all-time highs from October of 2021. They actually, for a fleeting moment, put in a new all-time high. But before the end of the month, we had such a small sell-off that we closed beneath those former highs. So not a new closing high for the month here in small caps. Still did manage a 3% gain for the month, but a breakout here would be a big deal for the U.S. equity market, small caps in particular. Now, developed international stocks, they too remain in an uptrend, and they are still among the best performing stocks globally in 2025. They were up just under 2% during the month of September, pulling further and further north of those former highs from 2007. 2007, 18 years, they went sideways, and now this train is starting to leave the station. So recently, I was back on the Stock Market TV morning show talking about the opportunity here in international markets. So take a listen to this excerpt from that interview. Yeah, and so here's the thing that I love. So we've got these secular bear markets highlighted, and then you get the breakout out of that. S&Ps have added 5,000 points since that breakout from at 1550. We've added 5,000 points. You've seen something more recently with gold, broke out of that base, has doubled in 2 years. But now you've got the international indexes that have broken out, just recently broken out of a 17, 18-year base. You've got the Nikkei that's broken out of a 36-year base. Where do we think these things are going? There are probably a lot of people out there, you go back and we're just looking for patterns, right? And that would have said, oh man, I wish I would have bought S&Ps in March of 2013, right? Well, here we are. We're giving you a similar setup, or you've got a similar setup right now in Nikkei, a much, much larger base. Where do you think this thing goes? Fast forward 5 years, 10 years from now. I would suggest it's going to be much higher. And now that these things are breaking out, you've got the technical momentum and backdrop that would suggest it is worthy of allocation. That money's got to come from somewhere. I think it comes out of U.S. equities, and these things are going to be the leaders. Now, needless to say, our thesis here at Reveille for a while has been that the diversifiers in a portfolio that have been laggards should start to become leaders. And I think that we have that type of opportunity on our hands with something like this in the international stock category. Now, emerging markets had another good month. They were up over 7% in September, and much of that coming on the heels of the news where the TikTok deal was able to go through. There is now a group of U.S. investors that are going to take over the domestic distribution and data collection within the TikTok app. Hopefully that's a sign of more good things to come in the U.S.-China trade talks. It seems to me, once again, as we saw in 2017, that despite the threats of tariffs, emerging markets are ignoring that rhetoric, and they are marching to their own drum. So yet another example of why we want to mute the noise and simply align with the price trends in the market. Now, one more thing for context here regarding emerging markets. Still obviously has a lot to do with what's going on in China. But the emerging market index, it is still below its former highs from 2007. So we talked earlier about how the developed international markets, they had recently cleared that. But the emerging market index, it's still lagging behind. It is yet to break out. We've got 18 years of no progress here. But back going 2007 and prior to that, this asset class, emerging markets, it was hot as a firecracker. Those are the early days in my career, and you would see people had their 401ks loaded up on this stuff because that's where the strength was in the market. But it's gone 18 years sideways, no progress in the emerging market space. And I would guess that we are likely to retest these former highs in the near term. But it wouldn't surprise me at all as we got up there if we chopped around for a little bit. Maybe the news between the U.S. and China, maybe it isn't great for some period of time, and that causes us to experience a little chop and consolidation. I think that would be perfectly normal after this run. But once this area of resistance, once it breaks and we could get north of that, there could be a lot of pent-up energy in this area of the market. Let's move on here. We're going to go to the bond market. So the U.S. aggregate bond index, it too remains in an uptrend. Now, as we discussed earlier, we talked about how the U.S. employment picture is continuing to soften. That's providing the Fed some ample room to lower rates. They did lower rates by 1/4 point here in September, and the bond market seems to be suggesting that we'll probably see another 1/2 point worth of rate cuts within the next year, but that might be about it. Now, Chairman Powell's term is up in January of 2026, and we're going to get a new Fed chair appointment from the Trump administration. Now, we've discussed at some length in our prior reviews that the street chatter is that they are looking for a very dovish replacement that could potentially drop interest rates very aggressively. But from our seat here, I don't think that that's what the market is really expecting or pricing in. They are not pricing in that the Federal Reserve is going to take the federal funds rate back to 2% or even 2.5%. If they were, if the market actually thought that, we would see it reflected in the yield curve today. But unless the Fed says something to suggest that the outlook for the economy is more dire than the market is anticipating right now, or that they are going to lower rates even further, then we probably shouldn't expect to see the bond market respond much when there are actually any announcements in terms of changes to Fed policy. So the market already seems to be pricing in that we're going to get about another half a point or so worth of cuts within the next 12 months or so. And until we see the Treasury curve change a little bit, don't think we should anticipate a whole lot more than that. But as it relates to the bond market itself, as long as it can continue to grind higher, it's certainly still worth having some allocation to. All right, we haven't talked about currency in a while, but we see that the U.S. dollar is in a downtrend. It's been a tailwind for a lot of asset classes this year, and I think that having a weaker dollar is an unspoken policy of the Trump administration because it serves to make domestic manufacturing more competitive. So the prospect of lower interest rates, it might further add to some weakening in this trend, although I'm really not completely sold on that argument. I do believe, however, that a weaker dollar can actually complicate the Fed's pursuit of lowering interest rates as much as they would like. So with the exception of oil, and we'll look at commodities here in the coming slide, most commodity prices have moved higher here in 2025, as they tend to do in weak dollar regimes. But if the dollar continues to fall and commodity prices more broadly, including energy, start to climb, that could keep inflation more elevated than the Fed would like to see, and that could thwart their efforts to lower rates more aggressively. So while the trend here for the dollar is down, and that's a positive for a lot of asset classes that we invest in, if the dollar continues to weaken and it causes inflation to actually increase because we see a rise in prices, in goods prices, that could actually thwart the Fed's efforts to lower rates. So something to be on watch about. All right, let's move on, talk about commodities here. So they've really been moving sideways for the last number of months. Not a whole lot to see here trend-wise at the index level, although maybe it's trying to put in kind of a rounding bottom here, finding support at the same level that it did back in 2021. Now, this Bloomberg Commodity Index, it is heavily influenced by energy. Its largest weightings are crude oil, gasoline, other distillate products like diesel fuel. So it saw a pop back in the summer when the geopolitical tensions were at a high with Iran and Israel. Those prices had gone from the low 60s up to the mid 70s for crude oil, but now they've fallen all the way back to the low 60s. All right. Now, what has actually helped this index keep its head above water has been the small amount of precious metals exposure that it has. Gold, silver, platinum, they've all had very strong years here in 2025, largely attributed to that weaker dollar that we've just discussed. Now we're going to wrap this overview here with a quick look at real estate. So real estate investment trusts, they also appear to be a little bit trendless. Maybe they're trying to put in a little rounding bottom formation here. Now, given this asset class's historical sensitivity to interest rates, if we do see rates continue to decline, maybe that's a positive catalyst for this category. Now, that's going to be it for this big picture overview. So if you're watching the public version here on YouTube, this is where our review for the month is going to conclude. For our clients, we're going to continue and we're going to highlight the holdings that we currently own within our strategies. Now, if you're interested in learning more about that, you can send us an email to info@reveillewealth.com and we'll be happy to follow up with you. So for now, I'm going to pass it back to Chad for a recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for that update. To recap, markets globally, including stocks, bonds, real estate, and commodities, all continued to trend higher during September. Signs of market rotation continued to appear also throughout the month as leadership within the U.S. and global equity markets has been broadening out. Yet on a different note, the U.S. labor market continues to weaken and may get worse with the recent U.S. federal government shutdown, resulting in up to 1 million federal workers being furloughed. Despite some sluggish economic data, it is important to note that ongoing uptrends across most areas of the equity market is a healthy sign of the strength of the current bull market and aligns with the thesis of rotation into other areas of the global stock market, which is long overdue. That said, a note of caution for us to keep a keen eye on is the excessive level of valuation and investor sentiment, especially within large-cap U.S. growth stocks that dominate the landscape. We highlighted one in particular, the Buffett Indicator, which reflects the total valuation of the U.S. stock market relative to the total output of the U.S. economy. This indicator is at unprecedented levels, reflecting extremes in the price that investors are willing to pay to own the U.S. stock market. Indicators like this one and multiple others lead us to take a prudent view of risk management at this stage in the market cycle. Currently, economic and stock market momentum are highly dependent on the AI boom, and given the level of investor euphoria and the degree to which the stock market's strength is tied to the AI theme, a prudent and logical evaluation is necessary. As always, we will utilize our rules-based investment discipline to help us discern market trends that are unfolding rather than attempt to predict any particular outcomes. And with that, Stephen, any final thoughts?
All right. Thank you, Chad. And thank you, everybody out there, for tuning in for these monthly updates. Our hope is that these reviews are giving you the timely insight that you want to have into not only what's going on in the market, but also the transparency of what's driving the decision making behind what we're doing here at Reveille to help you achieve your financial goals. Until next month, everyone, happy fall, be well. As always, if you have any questions, please send us an email to info@reveillewealth.com.